You see, most men come into this game with the wrong idea from the very start. They think trading is about money, dollars, profits, winning trades stacked one after another. But let me ask you something. Have you ever noticed how the man who chases money is the very one who loses it most consistently? I learned early that the market does not reward need, it rewards discipline. And discipline is not something you switch on when you feel like it. It is something you become. Trading, if you are to survive it, must stop being something you do and start becoming something you are, your identity, your way of thinking, your way of acting when no one is watching. Now consider this. When you sit in front of a chart, what are you really doing? Are you observing, or are you hoping? Because the difference between those two is the difference between a professional and a gambler. A man who observes waits for the market to reveal its hand. A man who hopes forces a story onto the market. And when you force the market, it has a way of forcing you right out of your position. I never made my money by thinking about money. I made it by thinking about being right, and more importantly, by acting right. You follow me? Because being right isn't about prediction, it's about execution. It's about doing the same correct thing over and over again, even when it feels uncomfortable. Let me put it plainly, when a trader focuses on money, he becomes emotional. And when he becomes emotional, he becomes inconsistent. And when he becomes inconsistent, the market takes his money. It's as simple as that. Cause and effect. Nothing mysterious about it. But when a trader focuses on execution, on following his rules, on reading the tape, on waiting for confirmation, something changes. His emotions quiet down, his decisions become clearer, and money, in time, becomes a byproduct. Not the goal, but the result. Now ask yourself, when you enter a trade, do you already know where you're wrong? Not where you'll take profit, but where you're wrong. Because that's where discipline begins. A man who does not know where he is wrong is not trading, he is guessing. You must understand this. The market does not pay you for being active. It pays you for being correct at the right time. And that requires patience. Real patience. Not the kind you talk about, but the kind you practice. The kind where you sit on your hands while others chase every tick. Most traders cannot do this. Why? Because they are addicted to action. They need to feel involved. They need to feel like they are doing something. But the market does not care about your need to feel busy. In fact, the more you trade without purpose, the more you expose yourself to error. So what should you do? You wait, you watch. You study behavior, price behavior, volume behavior, the relationship between movement and hesitation. You learn to recognize when the market is under accumulation, when it is under distribution. Not by guessing, but by observing repeated patterns. And when you see your setup, your real setup, not something you invented out of boredom, you act decisively, without hesitation. Because hesitation, at that moment, is just another form of doubt, and doubt has no place in execution. But let me ask you this. What happens after you enter the trade? Do you start watching your profit and loss tick up and down? Do you feel your heart move with every fluctuation? If you do, then you are still focused on money, and money will continue to control you. A disciplined trader watches the market, not his account. He measures whether the trade is behaving as expected. If it is, he holds. If it is not, he exits. No drama, no negotiation. Because he understands something most never do. The market is always right, and his job is not to argue with it. You see, identity shapes behavior, and behavior shapes results. If you identify as someone trying to make money, your actions will reflect urgency, impatience, and fear. But if you identify as a disciplined executor, your actions will reflect control, clarity, and precision. Which one do you think survives longer? Now here's something most won't tell you. Discipline is not tested when things are going well. It is tested when you are wrong. When the trade moves against you. When your analysis fails. That's when your true identity shows itself. Do you cut the loss quickly, as planned? Or do you hesitate, hoping the market will come back? Because hope is the most expensive habit a trader can have. And understand this clearly: every time you break your rules, you weaken your identity. You teach yourself that discipline is optional. And once discipline becomes optional, consistency disappears. On the other hand, every time you follow your rules, especially when it's difficult, you strengthen something far more valuable than any single trade. You strengthen your process, your confidence, your identity as a professional. Let me give you something practical. Before every trade, ask yourself 3 questions. First, what is the setup, and have I seen it play out before? Second, where am I wrong, and am I willing to accept that loss? Third, does this trade align with my plan, or am I forcing it? If you cannot answer those questions clearly, you have no business being in that trade. You must begin to see trading as a game of probabilities, not certainties. No single trade matters, but your behavior across many trades. That is everything. Because in the long run, it is not your intelligence that determines your success. It is your consistency, and consistency is born from identity. Now think about this. When you wake up and approach the market, who are you? Are you a man looking to make money today, or are you a man committed to executing his method, regardless of outcome? Because those 2 men will live very different trading lives. One will chase, react, and struggle. The other will wait, act, and endure. And over time, the market will make the distinction clear. You don't build wealth by chasing profits. You build it by protecting capital, by compounding small edges, by staying in the game long enough for your method to work. That's not exciting, but it is effective. And effectiveness is what pays. So the next time you look at a chart, don't ask yourself, how much can I make? Ask yourself, am I executing correctly? Because when execution becomes your focus, something subtle begins to shift. You stop needing the trade. And when you stop needing the trade, you begin to see it clearly. The market does not care what you want. That is the first truth a trader must come to terms with. You may want profits, you may need a winning trade, you may even feel you deserve it after a series of losses, but the market does not respond to any of that. It responds only to behavior. To what you do, not what you wish would happen. Now think about that for a moment. How often have you entered a trade because you wanted it to work, rather than because it met your conditions? You've seen it before, a chart that almost fits your setup, price that looks like it might move. And instead of waiting, you act, not because the signal is clear, but because your desire is strong. And what follows? Uncertainty. You begin watching every tick. You question your decision. You hesitate when you should exit, because deep down, you know the trade was not based on behavior. It was based on desire. You see, the market is a place of cause and effect. When a trader acts on impulse, the result is inconsistency. And when results are inconsistent, confidence begins to erode. Not because the market is difficult, but because the trader himself has become unreliable. But when a trader commits to behavior, clear, repeatable behavior, something changes. He is no longer reacting, he is executing. He is no longer chasing, he is waiting. And waiting, in this business, is not weakness. It is control. Let me ask you, do you have rules that you follow even when it costs you a trade? Because that is where behavior becomes real. Anyone can follow rules when it's easy. But the professional follows them when it's difficult. When the market is moving fast. When it feels like an opportunity is slipping away. Because he understands something most never do, missing a trade is far less damaging than taking a bad one. Behavior, repeated over time, becomes identity. And identity shapes every decision you make. If your behavior is inconsistent, sometimes disciplined, sometimes impulsive, then your results will reflect that inconsistency. You will have good days and bad days, but no stability, no foundation. But if your behavior is steady, if you wait for your setups, define your risk, and execute without interference, then even your losses begin to look different. They become part of the process, not a failure of it. Consider this carefully. 2 traders can have the same strategy, the same charts, the same information. One makes money, the other loses. Why? Because one follows his behavior consistently, and the other does not. It is not the method that fails. It is the execution. So what should your focus be? Not on how much you can make, but on how well you can follow your own rules. Can you sit through inactivity without forcing trades? Can you accept a loss without hesitation? Can you hold a winning position without cutting it short out of fear? These are questions of behavior, not knowledge. And here is where most traders go wrong. They measure success by outcome. A winning trade feels like success. A losing trade feels like failure. But that is a dangerous way to think, because a good trade can lose and a bad trade can win. If you judge yourself by outcome, you will reinforce the wrong habits. Instead, you must judge yourself by behavior. Did you follow your plan? Did you manage risk correctly? Did you act according to your rules? Or did you let emotion take control? Because over time, behavior compounds. Just like money compounds, so do your actions. One impulsive trade may not seem like much, but repeated often enough, it becomes your default. And once it becomes your default, it defines your results. So the real question is not whether you want to make money. Of course you do. Everyone does. The real question is, are you willing to behave in a way that deserves it? A trader can look confident when things are going well. That's easy. Anyone can hold a winning position. Anyone can feel certain when the market moves in their favor. But that's not where identity is revealed. The truth shows itself when the trade goes wrong. Let me ask you, what do you do the moment price moves against you? Not what you think you should do, but what you actually do. Do you act immediately or do you pause? Just for a second, hoping it turns back. That pause tells you everything. Because in that moment, there are only two paths. One is discipline. The other is hope. And hope, in this business, is a quiet destroyer. It doesn't feel dangerous at first. It feels reasonable. It feels patient. But it slowly pulls you away from your rules. You see, every trade begins with a plan. You define your entry, your risk, your invalidation. At least, that's what a trader is supposed to do. But the real test is not in making the plan. It is in respecting it when it becomes uncomfortable. When the market touches your stop, what happens next? A disciplined trader exits, cleanly, without argument, because he already accepted that loss before he entered the trade. To him, the loss is not a surprise. It is part of the cost of doing business. But the undisciplined trader hesitates. He widens the stop. He tells himself the market is just shaking him out. He starts looking for reasons to stay in instead of reasons to get out. And just like that, a small, controlled loss begins to grow. Cause and effect. It always is. When you refuse to accept a small loss, you invite a large one. And when losses grow beyond control, something else follows. Emotional pressure. Now you're no longer thinking clearly. You're reacting, trying to recover, trying to fix what should have been prevented. Now, ask yourself, have you ever taken a loss that was bigger than planned and immediately felt the urge to win it back? That's not strategy. That's emotion stepping in where discipline failed. And it all began with a single decision, to not accept being wrong. You must understand this: being wrong is not the problem. Staying wrong is. The best traders I've known were not always right, but they were always quick to admit when they were wrong. That's what kept them in the game, because trading is not about avoiding losses. It is about managing them. Now consider the opposite situation. You take a loss exactly as planned. No hesitation, no adjustment. What happens then? You remain calm. You remain clear. You are ready for the next opportunity. Your capital is intact, but more importantly, your mindset is intact. That is the real advantage. You see, every time you handle a loss correctly, you reinforce discipline. You strengthen your identity as a trader who acts, not reacts. And that identity carries forward into every decision that follows. But every time you avoid a loss, delay it, or deny it, you weaken that identity. You teach yourself that rules can be bent, that discomfort can be escaped, and over time, that becomes your habit, and habits in trading are everything. So when a trade goes against you, don't ask, can this still work? Ask, am I following my rules? Because the market does not reward stubbornness. It does not reward attachment. It rewards clarity and action. A trader who can exit without hesitation has something most never develop: control under pressure. And control is what separates survival from failure in this game. Because sooner or later, every trader faces the same moment. The trade is wrong. The market is not doing what it should. And there is a decision to be made. Not about the market, but about himself. A man who sits down at the market thinking about money has already placed himself at a disadvantage. Not because money is unimportant, but because of what that focus does to his mind. Let me ask you, when you are thinking about how much you can make, are you really seeing the market clearly, or are you seeing what you want to happen? Because the moment money becomes the focus, emotion follows close behind. You begin to measure every tick in terms of gain or loss. A small move in your favor feels like relief. A small move against you feels like pressure. And just like that, your decisions are no longer based on observation. They're based on feeling. Now consider what happens next. When a trader becomes emotional, he begins to interfere with his own trades. He exits too early because he fears losing profit. He holds too long because he fears realizing a loss. He adds to positions out of frustration, not logic, and all of it stems from the same source. His attention is on money, not on execution. You see, the market demands a certain kind of thinking. Clear, steady, and detached. But when your mind is tied to outcomes, how much you're up, how much you're down, you lose that detachment. You become reactive. And a reactive trader is an inconsistent trader. Cause and effect. Always. Now let me turn it around for you. What happens when a trader shifts his focus away from money and onto execution? When his only concern is whether he is following his rules, reading the chart correctly, and managing risk properly. Something quiet begins to happen. The emotional noise fades. He is no longer riding the ups and downs of his account balance. Instead, he is focused on process, on behavior, on doing the right thing regardless of immediate outcome. And when a man operates that way, his decisions begin to stabilize. He enters trades because they meet his criteria, not because he wants to make something happen. He exits trades because the market tells him to, not because he feels uncomfortable. He lets profits run when conditions remain valid, and he cuts losses when they do not. There is no argument, no negotiation, just execution. Let me ask you this. Have you ever taken a perfect trade and still managed to mishandle it? Closed it too early or held it too long? That wasn't a failure of analysis. That was a failure of focus. You stopped executing and started thinking about money. And the moment that shift happens, control slips. A disciplined trader understands that money is the result, not the objective. His objective is simple: follow the plan, protect capital, and act without hesitation when conditions are met. Everything else is secondary. Because here's the truth most overlook. Profits are not created in the moment of the trade. They are created in the consistency of behavior over many trades. One correct action, repeated over and over again, is what builds equity. But one emotional decision, repeated often enough, is what destroys it. So the question becomes, what are you reinforcing each time you trade? Are you reinforcing patience, discipline, and clarity? Or are you reinforcing urgency, fear, and impulsiveness? Because whatever you reinforce becomes your default, and your default is what shows up under pressure. Now think about this carefully. If you removed money from the equation entirely, would you still take the same trades? Would you still enter at the same points, exit at the same levels, manage risk the same way? If the answer is no, then money is influencing your decisions more than it should. A professional trader aims to reach a point where the presence of money does not change his behavior, where a trade is simply a decision to be executed, not a gamble to be won, where risk is accepted before entry, not feared after. And that kind of thinking cannot exist alongside emotional attachment to profit. So when you sit down to trade, shift your attention, not to what you can gain, but to how well you can perform, not to the outcome, but to the process. Because when execution becomes consistent, something else follows quietly, almost unnoticed at first: clarity in decision, stability in action, and a kind of confidence that does not depend on whether the last trade was a winner or a loser. A confidence built not on results, but on behavior. Most men believe trading is a thinking game. They spend their time searching for better indicators, better systems, better predictions. They believe if they can just become more intelligent, more informed, they will finally unlock consistency. But let me ask you something. Have you ever known exactly what to do and still failed to do it? That's where the truth begins. Because trading is not a test of how much you know. It is a test of whether you can act on what you know consistently without deviation. And that is not intelligence. That is discipline. You can recognize the perfect setup, wait for confirmation, plan your entry, define your risk, and still hesitate when the moment comes. Why? Because something interferes. Doubt, fear, the memory of the last loss, the desire to be certain. And in that hesitation, the opportunity passes. Now consider the opposite. You enter the trade exactly as planned. No hesitation. But then the market moves slightly against you. Not enough to invalidate the trade, but enough to make you uncomfortable. What do you do then? Do you trust your plan, or do you exit early to relieve the pressure? That decision has nothing to do with intelligence. It has everything to do with discipline. You see, discipline is what allows a trader to act in alignment with his plan, even when his emotions are pulling him in another direction, and emotions in this business are constant. They do not disappear. They must be managed. Let me make it clear. Every trade presents two forces. One is your system, your rules, your structure. The other is your emotion, fear, greed, impatience. And whichever one you follow repeatedly becomes your operating pattern. So ask yourself, what do you follow more often? Because if you follow emotion, even occasionally, you introduce inconsistency. And inconsistency is what breaks performance over time. Not a bad strategy, not a difficult market, but inconsistent execution. Now think about cause and effect. When a trader breaks his rules and gets away with it, perhaps even makes money, what happens? He reinforces the wrong behavior. He begins to believe discipline is flexible, that rules are suggestions, not requirements, and that is where the damage begins. Because eventually the same behavior leads to a loss, but now it's larger, less controlled, and far more damaging than it needed to be, all because discipline was treated as optional. On the other hand, when a trader follows his rules strictly, even when it leads to a loss, he reinforces something far more valuable than a single winning trade. He reinforces consistency. And consistency, over time, produces stability. Let me ask you this. Can you take 10 trades in a row exactly according to your plan? Not 9 out of 10. Not almost. But 10 without interference, without adjustment, without emotion stepping in. Most cannot. And that is why most struggle. Because the edge is not just in knowing what to do. It is in doing it repeatedly, without compromise. That is where results are formed. Not in isolated moments of brilliance, but in steady, disciplined execution. A trader who lacks discipline is like a man with a map who refuses to follow it. He may know the destination, but he will never reach it consistently. And here is something worth understanding. Discipline is not built in moments of ease. It is built in moments of discomfort. When you want to enter early, but you wait. When you want to hold a loss, but you exit. When you want to take quick profit, but you let the trade develop. Each of those moments strengthens control, and control is what allows a trader to operate clearly under pressure. Because pressure will come. The market will test you. It will move fast. It will reverse unexpectedly. It will create situations where your emotions rise quickly. And in those moments, you will not rise to your level of knowledge. You will fall to your level of discipline. So the question is not how much you know. The question is, can you do what you know every single time it matters? Most traders spend their time searching for an edge in the wrong place. They look for a better indicator, a more precise entry, a secret combination that will give them certainty. They believe the strategy is the key. But let me ask you, how many times have you changed your method only to find yourself making the same mistakes? That should tell you something. Because the truth is, the edge is not just in the strategy. The edge is in your ability to follow that strategy without deviation. A method, no matter how sound, is only as effective as the person executing it. You can have a proven setup, clear structure, defined rules, logical risk, and still fail to produce results. Not because the setup doesn't work, but because you don't work it the same way each time. Now think about that. If your execution changes from trade to trade, sometimes you wait, sometimes you rush, sometimes you cut losses quickly, other times you delay, how can you expect consistent outcomes? You can't. Because consistency in results comes from consistency in behavior, and behavior is what most traders neglect. Let me ask you something simple. Do you follow your rules exactly the same way when you're confident as you do when you're uncertain? Or do you make small adjustments, just this once, just to be safe? Those small adjustments are not harmless. They are the beginning of deviation, and deviation, repeated over time, erodes your edge. You see, a trading edge is not a single trade. It is a pattern that plays out over many trades. Some will win, some will lose, but over time, the probabilities work in your favor, if and only if you execute consistently. But the moment you begin to interfere, skip valid setups, take invalid ones, move your stops, exit early, you break that pattern. You step outside the conditions that made the strategy effective in the first place. Cause and effect again. When you follow your system precisely, you give it the opportunity to perform. When you deviate, you introduce randomness. And randomness does not pay. Now consider this: two traders using the same strategy. One follows it with discipline. The other adjusts it based on how he feels in the moment. Who do you think will see the true edge? It won't be the one with more intelligence. It will be the one with more consistency. Because the disciplined trader allows the probabilities to unfold. He takes every valid setup, manages risk the same way, and accepts both wins and losses as part of the process. Over time, his results reflect the strength of the method. The undisciplined trader, on the other hand, never sees the full picture. He interferes too often. He avoids losses that should be taken, takes trades that shouldn't be entered, and exits winners prematurely. And then he blames the strategy, but the strategy was never the problem. Let me ask you this: have you ever abandoned a system after a series of losses, only to see it work later? That's not bad luck, that's inconsistency. You stepped away before the edge had time to show itself, because no method works every time. That is not how trading operates. The edge reveals itself over a series of trades, not in isolation. And that requires trust, not blind faith, but trust built on testing, observation, and repetition. But trust cannot exist without discipline. If you do not follow your own rules, you will never trust your results, and without trust, hesitation enters. And hesitation disrupts execution. And once execution is disrupted, the edge disappears. So what should you focus on? Not improving your strategy every week, not searching endlessly for something new, but refining your ability to do the same thing, the right way, every time. Can you take every valid signal without hesitation? Can you accept every loss as planned? Can you hold every winner according to your rules? Because that is where the real edge lies, not in complexity, but in consistency. Not in knowing more, but in doing better. And the trader who understands this stops chasing perfection in strategy and begins building precision in execution. He stops asking, is this system good enough? And starts asking, am I following it well enough? Impatience is one of the quietest weaknesses a trader can carry, and at the same time, one of the most destructive. It doesn't announce itself loudly. It doesn't feel like recklessness. In fact, it often disguises itself as urgency, as opportunity, as the feeling that you must act now or miss something important. Let me ask you, how often do you feel uncomfortable doing nothing? Sitting in front of the chart, watching price move, and not being involved? Does it feel like you're falling behind? Like you should be doing more? That feeling, that's where impatience begins. You see, the market does not reward activity. It rewards precision. But most traders equate activity with progress. They believe the more they trade, the more chances they have to make money. And so they begin to take trades that are not fully formed, setups that are incomplete, signals that are not confirmed. And what follows? Overtrading. Now understand this clearly. Overtrading is not just taking too many trades. It is taking trades without purpose. Trades that do not meet your criteria. Trades driven by boredom, by fear of missing out, by the need to feel engaged. And every one of those trades carries risk. So when you increase the number of unnecessary trades, you increase your exposure to unnecessary losses. Cause and effect. Simple, direct, unavoidable. But there is something deeper here. It's not just the number of trades, it's the quality of your decisions. Because when you are impatient, your standards begin to drop. What once looked like a weak setup now looks good enough. What once required confirmation now feels optional. You start negotiating with your own rules. Let me ask you this: Have you ever entered a trade and, the moment you did, realized it wasn't quite right? That quiet feeling, just beneath the surface, telling you the setup wasn't there. That's not bad luck, that's impatience at work. A disciplined trader does not trade often. He trades well. He understands that the best opportunities are not constant. They are selective. They appear under specific conditions, and they require waiting. Real waiting. Not watching 5 charts and jumping at every movement, but waiting with intention. Waiting for alignment. Waiting for clarity. And here's the part most overlook. Waiting is not passive. It is an active decision. It is control in its purest form. Because every moment you choose not to take a low-quality trade, you are protecting your capital. You are preserving your focus. You are keeping yourself aligned with your method.